Yeah, the numbers are coming out right now. And remember, yesterday he told us they were going to be more data dependent, so these numbers are more important. Let's start with what I think is most important today, and that's personal income and spending. Personal income is up 0.5, higher than expected, plus 0.4. Personal spending is plus 0.6. Higher than the expected, plus 0.4. This is a big deal. Yesterday, he told us that he was kind of on a pausing path, and if he starts to see wage inflation, the last thing the stock market's going to want is to think he's going to tighten because he has to. Now on to initial jobless claims. We were expecting 220. We got 234, so a little higher than expected. Everybody knows that the labor market is pretty strong, so I think people are just not going to worry about that for now. The PCE deflator month over month is plus 0.2, which is as expected. Year over year, 2.0%, which is a little bit below. We were expecting 2.1. The reaction in the market, we were coming in a little under pressure in the stocks. I think that's mostly because we saw a little bit of a spike in LIBOR that a lot of people are talking to think is related to the Deutsche Bank story. So we're still under a little bit of pressure, down 6 in the stocks. As you said, the 10s was 3.01. It stays 3.01. Back to you, Becky.
All right, Jim, thank you very much. Jim Iuorio. Jim, very quickly, comments on the 10-year note. With Powell's comments yesterday, we've already seen this kind of playing out, but where would you think things are headed next? Below 3% or back to 3.3%?
It's funny to me because the initial reaction is lower long-term rates, but I think in the end, if this could signal somewhat of a risk on, and then the stock markets are very buoyant and get out of the little bit of funk they've been in, eventually that could be a little bit of a curve steepening because people wouldn't want to buy 10-year if it represents better value to buy stocks. So I think the initial reaction to have lower rates is fine, but in the end, I think it could turn around and be higher rates.
Okay, Jim, thank you. Jim Iuorio.
Thank you.
CNBC senior economics reporter Steve Liesman joins us right now with more from Washington. And Steve, your take on this data?
Well, I think it's good data. The one I'm focused on right now, I know the Fed is focused on the inflation data, but let's take a look at the other data, the personal income data, up 0.5% after 0.2 in September. Wages and salaries up 0.3%. Consumption up 0.6%. These are good numbers. Not exactly sure what's dialed into the GDP forecast in our rapid update, but these are good numbers. The inflation data, right on target. This is the Fed's preferred inflation indicator, and I'm looking here at the core PCE index at 1.8, right around there, so that in line with what Powell said yesterday. And just to, I know you got Megan Green coming up in a second, but I just wanted to show you the Fed's views on neutral. Remember that the Fed chairman said that we're just below the broad range of estimates. So here are the actual estimates of the Fed participants, okay? Each one of these represents an interest rate and where they think the long run rate ought to be. 3 members at 2.5, 4 at 2.75, 6 at 3%, 1 at 3.25, and 1 at 3.5. Now, coincidentally, if the Fed raises in December, each one of these bars would represent a rate hike en route to neutral. So you tell me, we are 1 below the bottom range, 2 below, 3 below the mid range, and 5 below the top range. And there is a lot of chatter out there among economists, I have to say, and I don't really want to pour cold water on this, that maybe the market took Powell a little bit too far when it came to his dovish. Definitely it was dovish, but how dovish was it? I do know that Mike Ferroli at JP Morgan sticking with his forecast for 4 rate hikes next year, and I believe Goldman Sachs doing the same, I'm told from my colleague Patty Dom, though I haven't seen the report. So there's still I think both of those guys are a little bit too hawkish, but in any event, the economists, relative to the markets, not quite as dovish.